up, everybody? It's Jonathan Bunk, and guess what? It's another episode of Hugh Knows. It's our guy Hugh over here.
Hey, what's up, everybody?
And we got a special guest today. We have Matt Kiker over here. Say hi, Matt.
Hello, Matt.
That's great. Matt's actually the president of Network Funding, and we're super thankful, super blessed for his leadership, and excited to have him part of the podcast today.
It's awesome to be here. Really glad to be.
Awesome. Well, one of the things we normally say when we start our podcast is we're Bunk & Baker Mortgage Group. We're a DBA of Network Funding, so all the opinions we share are not a reflection of our parent company. We're not giving any legal advice or financial advice, but we got Matt here, so he'll split the hairs on some stuff for us.
There you go.
Awesome. Well, today we're going to talk about a few different topics. We'll pick Matt's brain at the end, but the first thing we want to hit is the CPI data that came out today, so we'll hit that very quickly. We'll look at what the market is assessing the Fed's going to do over the next few months. Then we're going to jump into the case for rising home prices, especially over the next 6 to 12 months. Then we're going to dig into the Mortgage Bankers Association forecast for loan originations and for interest rates, and then again, we'll end with some insight from Matt and his years of experience in the industry. So let's jump to it and look at the CPI data. So,
oh man, brace yourself.
Yeah, so CPI data came out this morning. It's September 13th when we're recording. And so you can see on display right now, I am showing both the top line CPI number in the gray and then the core CPI number. The top line number went up to 3.7%. In August, and so that was not the what we wanted to see, but the core number did come down, and of course it's that core number that the Federal Reserve is more focused on. And really the news, since it was mixed today, the market has been mostly neutral. We haven't seen a big increase in yields for the 10-year or decrease for the 10-year either. So it's sort of a neutral reading.
What caused the uptick on the top line?
Yeah, so I think that it's mainly from energy prices. So in August, we saw an increase in oil prices, for instance. And so that was a large component of what was driving that top line number. And remember, the core number strips out the effects of food and energy. So the impact from the increase in oil prices is not seen in the core CPI number. And of course, it's that core CPI number that the Fed feels like it has the most impact and influence over, and not as big of impact on food and energy prices.
Yeah. So Matt, I guess if you're in Houston, it's a double-edged sword, right? Oil and gas is going up, which means people got work, income, can buy houses.
That's right.
But now inflation ticked up a little bit.
It has. And it just keeps going up all the time, and sometimes we feel it, sometimes we don't. We're still out there buying stuff and doing things. So
I filled up this morning, and it was like $4.90 something a gallon.
Right.
So you can feel it at the pump.
wow,
Yeah, absolutely.
You got premium then.
Yeah.
You were definitely
Mine's like $3.19.
Yeah.
Wow.
But there is some good news as far as like the inflation data, and that's regarding rents. And so a big component of the CPI is shelter costs.
The housing piece.
The housing piece. And so that's one of the things that has been slow to come down. And so what we're showing on display right now, it's from Realtor.com, and it's looking at the median rent in the U.S., looking at the absolute level in the red, and then in the black, it's showing the year-over-year change. And you can basically see that even though rents are slightly higher this year than the beginning of the, right now versus the beginning of the year over year, we've seen rents fall. We're in negative territory now. So rates versus last year for rent are lower. And so what that's indicating is that shelter costs are starting to come down. The way the CPI calculates shelter costs is sort of a 12-month lagged basis. So this is more real-time data, and what it's showing is that in real time, shelter costs are coming down. And so that is positive news for the future of inflation.
This might be a total hard question to answer, but how many people in the U.S. rent versus own a house? Does anybody have an anecdotal guess?
No, I don't. I mean, I don't know. I would imagine there's more homeowners than renters.
Yeah, like 60-40 maybe or something like that.
Maybe.
So I mean, the rent piece is still really significant, though.
It's a substantial.
I rented from 18 to 30
Right.
for 12 years. And a lot of people don't get into homeownership until their late 30s or 40s.
Yeah, no, we see that often. So, but still, a large, like you're saying, a large portion of the people that are living are renting, and so that's going to be a big impact if they're having to pay less in rent. So, good news for the future of inflation, even though we kind of had a bit mixed bag today. Let's jump into the next section and see what the market is assessing the Fed's going to do based on the data that we saw today. Okay, so we show this chart usually on every episode, and basically what we're showing is the market's assessment of what the Fed is going to do versus what the Fed has put out in its latest dot plot. Now, the dot plot came out in May, so it's a little bit old data, but they haven't released a new one. But of course, the market data is from yesterday, and you can see essentially that the market is assessing that interest rates will not fall this year. They're not going to rise this year. The market is saying that too. I mean, it's fairly balanced to whether we'll see an increase, but the majority of the market is still saying that we won't see an increase. And then you can start to see that as we get into the later part of 2024, they're expecting that the federal funds rate to come down, which is in line with what the Fed is saying. And so I think this is positive news. This hasn't changed with the CPI data that came out this morning, and it's just showing that the market is still expecting rates to hold steady and then start to fall next year, which obviously is what we're expecting as well.
Yeah, it's interesting to see how they had that dot go down so much in January. It's like hey, that's whenever the credit card bills are due or something. I don't why.
No, they give an annual forecast. So there's the 2023 forecast, and then the 2024 forecast, and then 2025. So it's an annual number. The way that it actually plays out probably won't be that large dip, but they don't tell us. They don't give us a monthly or a meaning-based forecast. They just tell us what their number is.
So it's likely
for
to
the year.
taper instead of just go
Yeah,
down
yeah.
like
probably
that.
won't just fall all of a sudden.
Yeah,
but
I was
it's
really
the
looking
average.
forward to January.
Yeah.
There.
I was gonna say. I mean, if you're in real estate, the word you want to hear is cuts.
Yes.
Like when is the Fed cutting rates?
Yeah.
And the answer is we do not know.
Right.
Exactly.
Not happening
We
in
don't know a
23.
precise date, but what the Fed has indicated and what the market is assessing is that sometime next year we're going to see rates fall.
Yeah, and I think what I've heard, you probably can agree, is spring, maybe early summer. It's not going to be January. It doesn't sound like.
That's right. Second quarter, third quarter, maybe.
Right, and you can see that that's basically what the market is saying, that we're going to see a slow decline starting after the first quarter.
Yeah.
All right, so jumping into the next section, we're going to look at what's the case for rising home prices. So we've obviously been in a sort of interest rate tightening cycle. We did see home prices fall a little bit in 2023 versus 2022. In Houston, that's been much more muted than the overall country. But yeah, what are we expecting as far as home prices and that sort of thing going into next year?
Well, I think with supply is everything for the realtors and for all of us. With the pricing of homes just is going to go up for as long as there's more demand than there is supply. Then rates will the housing won't. It'll be more expensive.
Right.
When rates go down eventually, and when we see them go down next year, we're going to attract more people to leave what homes they have at these lower rates to buy something new. And so there's going to be more competition for lesser homes. However, they're going to be putting their homes on the market, but they're going to be putting up at higher prices. So I think we're going to see probably home prices continue to rise over the next couple of years.
Right. Yeah, and on display right now, what I'm showing is the breakdown of the mortgages on the books throughout time, and based on what interest rate those mortgages have. And so what you can see is in 2022, we were starting to see, well, in 2021 and 22, we saw a big increase in very low interest rate mortgages. And around 80% of the market has a mortgage of 5% or below. Mm-hmm. Now, of course, we were looking at the interest rate expectations for next year in that last slide, and we are expecting rates to come down next year. And we expect that, particularly if rates come in the 5.5% range, you're going to see a big uptick in people entering the market either to refinance or to purchase, because it sort of lowered the barrier to entry. If I have a 5% rate on my mortgage and interest rates on my current house, and interest rates are 7.5%, that's a big difference in interest rate. But if interest rates are at 5.5% or 6%, then that's a much lower difference. And so that lowers the barrier for me wanting to jump in to refinance or to purchase. And so as we see rates come down, we're going to see a large swath of the market get incentivized to buy or to refinance.
Right. So even at 6.25%, you might be going away from what you had before. There's other things that are going on here as well. As the folks that have these mortgages are paying them off.
Yeah.
So you're going to see more cash buyers possibly because they've already paid off
Great
and now
point.
they've got a whole ton of equity. Somebody that's going to buy a home that's downsizing possibly.
I was about to say all the boomers going to be downsizing.
All of a sudden,
soon.
you've got more homes coming on the market and cash buyers coming in, so they didn't care about the rate. They had enough to already buy.
Yeah, absolutely. And to your point about homeowners' equity on these next two charts, we want to talk about that. So on the left right now, I'm showing U.S. mortgage debt versus homeowners' real estate equity. Yeah. And essentially what this is showing is that currently U.S. homeowners are sitting on historically high levels of equity, which is great. And that's reflective of the high prices that we've seen over the past few years. Prices have gone up. And so homeowners have been able to build a lot of equity. Okay, so what does that mean? Well, that means is that there is at least the potential to refinance. And then if you look at the chart on the right, I'm showing mortgage originations, so mortgages that originated by quarter, and the credit score associated with those. And so what you can basically see is that, in the past few years, we've had maybe a slight uptick in that 720 category, but overall we have really high quality borrowers that have mortgages. And they have equity. Mm-hmm. And so what that means is that they have the ability to refinance or leverage that equity into a new purchase. Because they have the equity, but also because they're good and they have good credit. Right. So that's another reason why we might expect prices to increase next year as rates fall, because you have high quality borrowers, they have equity, and they can use that equity to go and make another purchase.
Right.
Yeah, and one of the things we love as a lender, when people have equity, they can get rid of PMI.
Yeah.
Right? And a lot of people that bought in 20 or 21, or not 20, but people that bought in 22 when rates got higher, they want to get that 7% rate down lower, and they want to get rid of that PMI. So it's like, if you bought in 22 and you're at 7% with PMI, and then rates get better in 2 years, you might have $100,000 of equity in your house, get rid of PMI, and now you're at 5%.
Yeah.
And you'll be so thankful you bought it that way.
Yeah, exactly. And your payment's going to be way lower, and then you would have locked in that price, several years ago before you saw any more appreciation.
We're also seeing consumer rates go up as well. So there's a big opportunity for all that equity to be used to get a better financial position rather than paying credit card rates or whatever.
24%.
Yeah, and I mean, we've shot videos and content about that too, leveraging the equity in your house to reduce your overall liability, your liability outflow, because, your credit card might be at 22%, your auto loan might be substantially higher, higher than your mortgage rate. And so using the equity in your house to pay off those and get a better overall interest rate. And so we've definitely, suggested that that's an opportunity right now. And then one last piece on the case for rising home prices, and we hit this almost every episode, and that is inventory is low. It's still super low. Now, this is just Houston. The rest of the country might be higher than this, but the fact of the matter is this has been pretty consistent. We pull this regularly, and the lowest I've seen it is 2.2. The highest I've seen it is 3.3. So it's really fluctuating between that, but the neutral level is 6 months of housing inventory, 4 to 6 months, depending on the market. And so we're just well below that level right now, which means that, hey, we're, supply, like you said, is what's largely going to dictate housing prices. And right now, the supply is pretty limited, and so
and back to what Matt said, if rates go to 5%, what do you think that 2.8 months of inventory is going to do? It's going to
go down.
It's going to go down.
Yeah,
because
absolutely.
more people are going to come in the market. So it's like, you think inventory is tight now? You think multiple offers are hard right now? And we talk about our 10-day close all the time. Get ready for 5% interest rates.
Yeah, you're not the only one thinking, if you're out there thinking this, that I'm going to wait until interest rates fall and then I'm going to buy. Yeah, you and everybody else, but what that's going to create is a surge of demand, and that's going to push prices up. So even though your interest rates fall, prices will be higher, and your payment most likely will be higher as a result. Okay, so jumping to the next section, we want to go through the Mortgage Bankers Association latest August forecast on loan units and on interest rates. So on display, I'm showing both the forecast and history for loan units as well as the 30-year fixed rate. That's on the right-hand side axis. And so you can basically see that in the second half of 2022, we saw a large decrease in the number of loans that were originated, and that has that you saw a little bit of recovery in Q2, and we're expecting that to be kind of flat for the rest of the year, versus that Q2 number. 2024, we're back to kind of 2019 levels as far as loan volume, which is really good in suggesting that we're sort of coming out of this, let's say, trough period for the industry. And that obviously corresponds with interest rates falling. So you can see the Mortgage Bankers Association is expecting interest rates to be at 5% by Q4 of next year. And if you just harken back to that slide, 80% of the market has 5% or below interest rates. So if we're getting close to that 5%, a lot of the market is starting to become, oh, well, maybe now it's a good time to buy, and now it's a good time to refinance, because again, the difference between their current mortgage and what they might get on a mortgage rate is not going to be as high as rates come down.
And if you're a realtor, you're probably wondering, like, why is loan origination volume so important? Well, Matt, historically, origination volume accounted for 90% of resale transactions? Maybe 10% were cash?
It could be. I mean, obviously it's more now, but more
Yeah, a
cash
lot more
transactions now. But we've got a whole bunch of first-time home buyers ready to get out there. We're at the tail end of millennials and now up Gen Zs, so there's pent-up demand there. There's people ready to buy.
Absolutely. So we're encouraged to see this forecast, and it's in line with what we are expecting as well. So good to see that. So moving on to the last segment, since we have Matt here, we're going to do some rapid-fire questions for Matt, and we want to walk through some of the issues that we think that are going to be most affecting the industry over the next few months and years, and just want to pick your brain, given you have a wealth of knowledge and experience in the industry. So that first one, loan runoff, what is it, and why does it matter to real estate agents?
Well, it matters to everybody because it kind of messes up the ecosystem for how we do business. Runoff is whenever we make a loan and somebody repays most or all of that loan within a short period of time, maybe 6 months or a year. And the problem is that we, as the lender, have put a lot of money into getting a loan approved. We've done all the work to get this loan done. And then we're selling off the loan. We sell off to the servicing, and that when we sell it, we're selling a future stream of payments. And if that future stream isn't the 7 years or 5 years or whatever we predicted it was going to be, then we have to pay back what we were paid for that stream. And when that happens at most companies, that means that the loan officer's commission is taken. It means that we've sunk all these costs into making a loan that we don't get to recoup, and it's just bad for business, bad for us. It increases the cost of doing business in the future, and we have to pass that cost on to the future buyers and borrowers that we have.
Yeah, I mean, runoff could make a mortgage company go bankrupt.
It could.
Yeah.
Yes.
So it's not a good thing for us. And I know realtors, I get this question often when we're talking with clients and their pricing. Why isn't there interest rate without points? And when rates are volatile like they are, Matt, where we're at a 23-year high on the 30-year fix, we could offer a higher rate at no points, but then we might end up having runoff, right? We could offer something at 8 at no points, but then we might have runoff right away.
There's really not a huge market. There used to be more, whenever rates were more stable.
Yeah.
We still have a fair amount of volatility out there. It makes people pay less for the asset out there in the world. So that is really what brings down what the overall pricing is, and why we all have to pay discount points at this point, is because there's just not high enough prices being paid out there for us to capture what we need in order to run our businesses. So when that comes back, then we won't have to. But at this point, all the valuable parts, we're all thinking that rates are going to go down. Well, servicers are thinking that as well.
Exactly. Yeah.
And servicers know that the life of that loan is going to be less, because as soon as rates go down, these guys are going to refinance.
Right.
So that means that they understand that there's a shorter duration.
So they demand upfront cash, essentially, to
offset the risk.
To offset that risk,
Yes.
right? And that's discount points.
The article I sent you yesterday, what was it? Like 50%.
50%, over 50% of transactions are
have
paying
points
Yes.
right now.
Right.
So, and maybe 3 or 4 years ago that wasn't the case. But
Right.
again, because of the volatility and because we're at sort of the market's expectations of this decline in rates,
Right.
that's what's causing this. So If you are paying points, that's the reason. So, what do you think about the loan industry? Are we going to see consolidation in 2023, and what impact will that have?
We've seen a lot of it already. There are many companies out there that have decided to just throw in the towel. They've joined forces with another company. We've seen, you guys have probably talked about it already, we've seen lots of LOs leave the industry, and it's just because there's less business and less to do, and people come up with new ideas on how to survive. Yeah. And sometimes that's consolidation, sometimes it's going out of business, sometimes it's just like us, we're going to go forward the way that we are. We've been in this business for 25 years. We know what to expect.
Which is a huge deal, realtors. Austin and I were sharing this last year a lot with realtors. We're meeting with Matt. We're like, Network Funding is an independent mortgage bank, and that's how we identify. And it was like 80% of independent mortgage banks in 2022 did not make a profit.
Right.
And Network Funding made a profit, which is important. It means we can stay in business. We can offer great service. We can do 10 days. And so I'm
it
very
shows
proud.
Resiliency of the company in a really tight market. I mean, a really difficult market.
Right.
Yeah.
And that's not even an 08, 09, 07, 8, 9. Living through all of that, this company made it just fine through all that too. So anyway, but consolidation, yes, going to continue to happen. We'll keep seeing more people kind of form up together, and we'll see a lot leave.
Matt, you are the president of Network Funding, but you are also the president of the Texas Mortgage Bankers Association
for this year.
And is there any news that what y'all are doing, or anything interesting that you'd like to share regarding that?
Yeah, we just got through our legislative session earlier this year. We made progress on the fronts that we wanted to as an industry. Those sessions only happen every 2 years, so we don't have to worry about that in 2024, which is I'm thankful for. And then in 25, we'll be looking back at our legislative agenda. As far as the association in general, what we're able to see is that it is a tough year for mortgage bankers. We've seen our membership dues have come down a bit. Our people that are renewing have come down a bit. We've seen attendance at our events go down a little. But I still think that our industry is very resilient and is able to make it through the hard times and get through. And I keep hearing it from everybody. I think we're all very optimistic as an industry all the time. If we weren't, we would all be on. Well, maybe some people are on antidepressants, but they're more needed now than they were in the past. I think we just came off this great cycle for mortgages, and now just kind of making our way through the rest of it. But as far as initiatives, I mean, we're really concentrating on what we call emerging mortgage bankers. We used to call them young mortgage bankers, but we've got newer folks that are entering the industry. Doesn't mean that they're necessarily young, but they're newer to our industry, and we're trying to make sure that they have all the tools that they need to be successful and to really move up.
That's awesome. As an employee of Network Funding, I'm very thankful that Matt's our president and he has a voice, with our governor, with the legislative body, because, just like TREC advocates for you as a realtor, and there's a TREC board set by Governor Abbott, the TMBA can meet with the powers that be in the state and really advocate for the loan officers, the loan originators that are out there, and helping us build a sustainable business where we can be successful to help you and we can continue to work together.
Right.
All right, well, what gives you pause about next year or this, in the next 12 months, and what gives you hope?
Well, pause, obviously, we're all just trying to get through it. We need some inventory. We need rates to be stable. I think rates, everybody my age can remember whenever rates were much higher than now.
In the teens.
And no one cares that's younger than us, is what I've found. It's like, well, that wasn't my
reality.
Rates are high. That's what it is to you. But like I think you said before, the 40-year average is in that 8.5 range, and to me that's always been kind of normal. Like all of this has been abnormal.
Right.
Even where we are right now is really a perfect rate, and it's a perfect time for first-time home buyers right now. I think if they can find a spot, this is the time to get it.
Yeah.
So and hope, what I see ahead is rates are going to they're going to go down a bit next year, the year after, and we're going to see some more normalcy. Just the flattening of expectations and just not as much volatility, I think, which hurts us all.
Absolutely.
Yeah. That's awesome.
So why can't we just float down or break a lock when a borrower enters into or agrees to lock in an interest rate? We get this question from agents a lot. If the interest rate falls after you lock in, well, why can't you float it down, or why can't you break the lock and relock? So why is that?
It's because we have a commitment on the other side. Whenever we don't have the ability to just make a best efforts commitment on the other side, whenever we're dealing with the volumes that we do as a mortgage company, we have start that one over. We actually have to take we have to buy something or sell something in the market that is a mandatory delivery. And when we do that, it means if we don't deliver, we have to buy at the then current rates to fill that commitment. And if I made all these locks and I make an expectation that I know all of them are not going to close, but I know that in our case, 80% are going to close. 80% is what I'm going to go ahead and commit. And if those don't all get filled, then I've got to go to the market and buy at the current market. So when rates go down, that means my commitments just became more expensive to fill. So I lose money on every deal. So, by offering a best efforts lock like we do to all of our borrowers, we're able to give them a benefit that they didn't have to pay anything for. And if they don't close, or if they don't close with us, then we're out the money on the other side for protecting the interest rate that they had, because they sure would want to be locked in at that rate should rates go up.
Right.
Yeah.
We don't go back to them and say, hey,
well, rates have gone up.
Yeah.
We need to increase
Sorry
the
about
rate.
that.
That's always my reverse psychology answer to borrowers. Like, hey, I know the market's improved, but we talked about it, and we felt like it was best for you to lock in based on everything. And the market got better. Like, that's what it is. But if the other thing happened, I'll call you and move your rate up.
Right. Yeah. And so one of the other things that we've seen, and I saw you had this on your slides also, but we have seen a bigger buybacks from all of our investors. If you think about how many loans were done in 2021, and then if everybody's taking a sampling of those loans in order to audit and come back to and say, oh, well, this had a problem or that had a problem, or things are just not performing, we've just got a really big bunch of loans out there, and typically the buyback period is in that 3 to 4 years, and they're really looking at loans closely, the ones whenever we had the biggest amount. So I think we're seeing part of the buybacks because there's been so many loans that were done over that period of time.
And a buyback is basically when you have a loan that has been sold, and then the person that owns the loan does an audit of the loan, and they see some sort of error or discrepancy such that they can force you to buy it back from them.
Yes, because we make reps and warrants as a company. When we sell, we say this loan it meets all the qualifications that you had for your program, and there's no fraud, there's no issue with the loan at all, and we did all the calculations correctly and all that. Usually, what trips it is that the loan goes bad. Somebody stops making their payments,
and then they look under the hood.
And then it's time to see, hey, what can we do to push this loan back on who originated it?
Okay.
So
yeah, that makes sense.
Kind of the reasoning for that.
Yeah. Oh, that's super insightful.
Yeah, thanks, Matt. Well, we appreciate you tuning into this episode of Hugh Knows, and we will catch you next time. Thanks.
Thank you.
Adios.